No music, no build-up, just the numbers. January 1st to January 31st. Across all 4 channels I bought with my 401k. Total revenue, $134.30. Not projected, not estimated, not on track. That is the number. That's what landed in the account. After 30 days. After dozens of uploads. After paying editors. After everything. Now zoom out. Monthly operating cost? Between $2,000 and $2,500. That means in January, this portfolio generated roughly 3 to 4% of what it cost to run. This isn't a slow start, this is imbalance. This is the kind of math that makes you check the numbers twice, then 3 times, then just sit there staring at the screen. If you're wondering, did it work? Right now, the honest answer is no. And if you think that's bad, wait until you see which channel made the most money. It's not the one with 100,000 views. It's the one you probably haven't even heard of. And that tells you something important about how YouTube actually works versus how most people think it works. Let's break it down. Channel by channel. No hype. No spin. Just data. First, Cinema V2. In January, 16,459 views, 376 watch hours, 23 subscribers, and revenue, $23.84. On paper, a 330% increase in views from December looks like growth, like momentum. But zoom out, $23 for 16,000 views. That's not scaling. That's barely monetizing. This channel has over 4,000 subscribers. People who at some point said, I want to see more from this channel. And in a full month, all of those people, combined with all of that new traffic, generated less than the cost of a tank of gas. Improvement at this scale doesn't move the needle. It just delays the problem. It gives you just enough hope to keep going without giving you enough results to actually get anywhere. And that might be more dangerous than failure. Because failure forces change. Mediocrity allows you to stay comfortable while you slowly bleed out. Next, Dark Lore. January performance, 15,677 views, 671 watch hours, 67 subscribers. Revenue $36.34. This is technically the strongest earner in the portfolio right now. Let that sink in. The strongest earner. The top performer. $36. And YouTube shows a 75% increase in watch time. A 63% increase in subscribers. Again, looks good on the surface. You'd highlight those percentages. You'd talk about trajectory. But here's what matters. $36. That's the best performing channel. Even when something works in this portfolio, it barely works. Even the winner is losing. Even the success story is a failure relative to what it needs to be. Now this one hurts. This is the largest channel, the one I expected to carry everything. January numbers, 112,075 views, 6,200 watch hours, 196 subscribers. Revenue, $22.56. Read that again. 112,000 views, $22. 112,000 human beings watch content on this channel. They clicked. They watched. And after all of that attention, after all of those ad impressions, $22. Revenue dropped 61% compared to December. Views dropped 31%. But the bigger problem isn't the drop, it's the RPM. Let's do basic math. 2256 divided by 112,000 views. That's roughly 20 cents per 1,000 views. To put that in perspective, most healthy long-form channels operate between $3 and $10. RPM finance channels, 15 to 25. Tech, 8 to 18. Even basic commentary often hits $2 to $4. This channel is operating at 20 cents, which means even if it did 200,000 views next month, it would generate around $40. Even if it did 500,000 views, it would generate around $100. The scale doesn't fix the math, The math is broken at the foundation. This channel generates attention, but not value. It proves something most people don't understand until it's too late. Views don't equal money. Monetization niche does. Military conflict content pulls massive audiences. It triggers curiosity, fear, engagement. But advertisers don't love it. Brands don't want their products running next to footage of explosions. And when advertisers don't compete, CPMs collapse. So this big channel, the one with 35,000 subscribers, the one that looks impressive, is financially the weakest per view. It's a trap. A trap that looks like progress, but functions like quicksand. Scale without monetization is an illusion. Now let's talk about Invention Flex, because this channel completely changes the story. In January, Invention Flex produced 710 views, 500 hours of watch time, plus 370 new subscribers, $51.56 in revenue. And that might not sound huge on its own, but compared to the other channels in the portfolio, it's actually the best performing channel right now, not just in revenue, but in growth. YouTube shows 29% more views than December, 58% more watch time, 70% more subscribers, 26% more revenue. That's real momentum. And more importantly, it's consistent momentum. Now look at monetization. $51.56 from 710 views. That puts the RPM around $1.44 per thousand views. That's not elite, but compared to the rest of the portfolio, it's solid. And more importantly, it's paired with strong subscriber growth, which means if this trajectory continues, the channel has real potential to scale. Cinema V, $23.84. Dark Lore, $36.34. Insido Military, $22.56. Invention Flex, $51.56. Total January revenue, $134.30, which means the full portfolio actually crossed $134 for the month. Still far from sustainability, but a very different picture than before, because now we know one channel is actually starting to move. For an entire month, across 4 channels, after cashing out a retirement account, after paying thousands in acquisition costs, after hiring editors, after strategy calls, after all of it, $134.30. At the start, there was still room for imagination. You could say, it's early. Optimization takes time. All of those things could be reasonable, but January was supposed to show direction. It was supposed to be the first full month with my systems in place. It was supposed to demonstrate whether this was fixable or not. Instead, it shows something more dangerous. Flat monetization. No breakout, no momentum shift. Just effort without leverage. Just work without multiplication. And here's the trap. When numbers aren't catastrophic, you can convince yourself they're acceptable. When you're not losing everything, you can convince yourself you're winning. They're not crashing. They're just there, hovering, doing enough to exist, but not enough to thrive. And stagnation with the burn rate is different than stagnation with no risk. If you're burning no money, stagnation is fine. You can wait, but every month that passes costs real money. And those dollars don't care about potential. They just leave. Something changed for me in January. In the beginning, this felt like an experiment, a calculated risk. Now it feels like exposure, real exposure. Because now we have proof. Proof that traffic doesn't guarantee revenue. Proof that growth percentages don't equal sustainability. Proof that buying existing channels doesn't mean buying existing leverage. I didn't buy compounding assets. I bought attention streams. And attention streams reset every month. Every month you start over. Every month you have to earn it again. That's not an asset. That's a job. A job with no salary and no guarantee. If 4 monetized channels with over 158,000 views can only produce $134.30, then the real question isn't, will it grow? It's, is the foundation broken? Because you can't build a house on a cracked slab. If the unit economics are broken, volume just accelerates the loss. This isn't a motivation problem, it's a model problem. So let's strip emotion out of this completely. Let's break it down channel by channel, not just what happened, why it happened. Let's go back to Insido Military. 112,000 views, $22. That's roughly 20 cents per thousand views. RPM isn't just a random number, it's a reflection of your content's value to advertisers. It's a reflection of your niche's commercial viability. This channel is operating at 20 cents, which means even 1 million views would generate only $200. 1 million views for $200. Do you understand how broken that is? 1 million views is the kind of month that launches careers. And on this channel, it would barely cover a week of operating expenses. The math is the problem. More views won't solve it. Now look at the audience behavior. 112,000 views. Only 196 subscribers gained. That's a conversion rate of about 0.17%. Which means viewers are watching, but they're not attaching. They're consuming the content, but they're not saying, "This is my channel." They're just passing through. And that's critical, because when most of your viewers are new each month, you don't have loyalty. You have a turnstile, not a community. Insido Military isn't compounding. It's reacting. It performs when there's tension in the world. It spikes when something happens. And it collapses when there isn't. That's not an asset. That's dependency. Now let's look at Dark Lore. 15,000 views, 671 watch hours, 67 subscribers, $36 in revenue. This channel actually improved month over month. Watch time up 75%. Subscribers up 63%. That sounds like traction. But look deeper. $36 from 15,000 views gives an RPM of about $2.32. That's better, actually in the ballpark of normal. So why is it still a problem? Because the total scale is too small. 15,000 views per month is a hobby. It's a side project. Even if Dark Lord doubled in performance next month, you'd be looking at maybe $70. Even if it grew like that for 6 months straight, you'd still be below sustainability. That's the problem with small numbers. Even impressive growth rates don't matter when the starting point is tiny. Growth rates matter, but starting point matters more. Dark Lore feels stable, but stability at this size is fragile. One algorithm shift, one change in viewer behavior, and stable becomes declining. It doesn't have a viral problem, it has a ceiling problem. Now Cinema V, 16,000 views, 376 watch hours, 23 subscribers, $23 revenue. RPM here is about $1.45. Mid-tier monetization. Not terrible, not great. But here's the deeper issue. Look at watch time. 376 hours from 16,000 views. That's about 1 minute and 20 seconds average view duration. That suggests average view duration is short. Really short. Which likely means shorts are driving traffic. Shorts get views. But shorts don't monetize like long form. They pay fractions of pennies. They inflate view counts. They make your channel look bigger than it is. But they don't build loyalty. And they don't drive the kind of viewing behavior that leads to sustained growth. Now look at subscribers. 23 subscribers from 16,000 views. That's a 0.14% conversion rate, which means viewers are consuming, but not committing. They're watching the short video, but they're not saying, "I want to see more." They're just scrolling, swiping, moving on. Cinema V2 doesn't have momentum, it has activity. It has motion without direction. It has consumption without commitment. This channel completely changes the story. In January, Invention Flex produced 710 views, 500 hours of watch time, plus 370 new subscribers, $51.56 in revenue. YouTube shows 29% more views than December, 58% more watch time, 70% more subscribers, 26% more revenue. That's real momentum. And more importantly, it's consistent momentum. Now look at monetization. $51.56 from 710 views. Now step back. Look at all four together. See the pattern. 2 channels have scale but horrible RPM. 1 channel has decent RPM but no scale. 1 channel has neither. That's not unlucky. That's structural. That's baked into the DNA of these channels. You don't have high scale plus strong RPM. You don't have strong retention plus advertiser demand. You have fragments of each, spread across 4 separate properties, scattered, diluted, divided. And that fragmentation is expensive, because you're paying over $2,000 monthly to maintain all 4. 4 editors, 4 content strategies, 4 algorithms to satisfy, when none individually justify the cost, when none individually come close to breaking even. This portfolio doesn't have a growth problem. It has a concentration problem. Effort is split. Capital is split. And none of the channels are strong enough to dominate their niche. They're all hovering in the middle. The middle where channels go to slowly die while their owners convince themselves things will get better. And middle is dangerous, because middle doesn't force action. It just drains. Slowly, relentlessly. If nothing changes, I can tell you exactly what happens. Inside military will continue generating attention without monetization. Dark lore will plateau modestly. Cinema V2 will fluctuate with shorts, never building anything real. True Depth HD will slowly decline until it's generating nothing. And combined, they will likely produce somewhere between $70 and $120 per month, month after month after month. Which doesn't matter when burn rate stays above 2,000. That's not scaling. That's survival mode. The problem is not views, the problem is math. Total January views, 157, 878. Total revenue, $134.30. Now compare that to cost. Monthly operating expense, $2,000. To break even at current RPM averages, you would need roughly 3 to 4 million views per month. Not 150,000. 3 to 4 million. That's the scale gap. That's how far away sustainability actually is. And when you see it that way, something shifts. Because now we're not talking about growth, we're talking about orders of magnitude. We're talking about 20x to 30x current performance. It's easy to default to hustle mode. It's easy to say, upload more, work harder. But look at the RPM distribution. If RPM stays where it is, doubling views only doubles a small number. 150,000 views to 300,000 views sounds impressive. But 300,000 views at current RPMs is maybe $170. Still nowhere near break even. You don't fix weak economics with volume. You can't outrun broken unit economics. You fix it with leverage. You fix it by changing the fundamentals. Right now, none of the 4 channels have strong leverage signals. None of them have the foundation for exponential growth. They have movement, but not acceleration. They're moving, but they're not building. We need to talk about shorts, because shorts are deceptive. They're a trap that looks like a shortcut. Shorts spike views. They spike subscribers. They make your analytics look better than they should. But they don't spike revenue proportionally. Shorts RPM is a fraction of long-form RPM, sometimes a tenth. And they don't convert viewers into long-form watchers. Someone scrolling shorts is in snack mode versus meal mode. Cinema V2 is likely leaning heavily on shorts traffic. The numbers tell the story. High view counts relative to watch time. Low subscriber conversion. Low revenue. That explains everything. Shorts viewers swipe. They don't settle. They don't become fans. And YouTube treats shorts and long-form audiences differently. If most of your traffic comes from shorts, you build a low-intent subscriber. Someone who clicks subscribe because it was easy, not because they care. And low-intent subscribers don't drive session depth. They don't trigger the algorithm to recommend you to others. Which means long-form never compounds. Which means you're stuck on the shorts treadmill forever. Now let's address something uncomfortable: time. At $2,000 per month operating cost, if this continues for 6 months, that's $12,000. If it continues for a year, that's $24,000. And January produced $134.30, which means January covered about 1.5 days of expenses. That's the kind of math that changes how you sleep. That's the kind of math that makes you question every decision that led you here. Because this isn't theory anymore. It's exposure. Real exposure. And exposure compounds negatively when revenue doesn't. You said something important. You said you're more stressed now than when you started. Not because it failed dramatically, but because nothing big changed. Nothing moved. That's worse. When something crashes, you react. The pain forces action. When something stagnates, you hesitate. You hope. You tell yourself next month will be different. And hesitation with a burn rate is deadly, because you convince yourself, one more month, but next month only changes if something fundamental changes. And if nothing fundamental changes, next month is just this month with different dates. The concentration question is the one I keep coming back to. Right now, effort is split across 4 channels, 4 editors, 4 audiences, 4 sets of problems. But look at the numbers. Which one has the highest RPM? Dark Lore at 232. Which one has the highest scale? Insight or Military? Which one is shorts dependent? Cinema V2. Now imagine this. What if instead of spreading $2,000 across 4, you concentrated it on 1? What if all that creative energy, all that editing budget, all that strategic focus went into a single channel? This is where the conversation shifts from data to decision, because diversification feels safe. Spread the risk. That's what they tell you. But in struggling portfolios, diversification can dilute momentum. It can spread resources so thin that nothing gets enough to succeed. None of these channels are strong enough individually. Not one, but one of them could be. If resources weren't fragmented across 4 losing bets. There's another layer here. Right now, revenue is 100% ad-based. Every dollar comes from YouTube placing ads. No sponsorships, no digital products, no memberships, no nothing. Which means you are completely dependent on CPM volatility, completely dependent on what advertisers are willing to pay this month in this niche for this audience. And CPM volatility is real. January is historically one of the lowest CPM months of the year. Ad budgets reset, spending drops, which means this might actually be the floor, the bottom. But here's the flip side. If January's low season, and this is $134.30, what does a normal month look like? 120? 150? That's still nowhere near sustainability. That's still a rounding error compared to expenses. So seasonality isn't the solution. It's just context. You cashed out a retirement account to buy assets. A retirement account. Money that was safe, you took it out, paid the penalties, and invested in YouTube channels. Because assets are supposed to do things. Assets are supposed to appreciate in value. Assets are supposed to produce cash flow. Right now, these channels are not appreciating. Nobody is offering to buy them for more than you paid. And they're not producing cash flow. January produced $134.30. Negative cash flow when you factor expenses. So what are they? Projects, hobbies, experiments. And that's fine. Unless they're financed by capital that can't be replenished easily. Unless they're burning money you can't afford to lose. That's where the pressure comes from. Not from the channels themselves, from what they're consuming. At this point, there are only 3 paths. Everything else is just delay. Path 1, double down. Increase quality. Focus on retention above everything else. Raise RPM through niche refinement and audience development. Path 2, consolidate. Cut the weakest channel immediately. Concentrate all resources on one channel. Give it everything the others were getting and see what happens. Path 3, restructure monetization. Add sponsors, build email lists, create digital offers. Stop relying on YouTube ad revenue entirely. Doing nothing is no longer neutral. Doing nothing is erosion. I misunderstood what I was buying. This is hard to admit, but it's true. When I cashed out my 401k, when I took over these channels, I told myself I was buying assets. Something that was already working, just needed optimization. But January exposed something. I didn't buy assets, I bought potential. And potential is not the same thing as leverage. Potential still requires proof. Potential still requires work. Potential is just a fancy word for not there yet, and proof is expensive. Proving something works costs time and money. Proving potential into reality is the hardest thing there is. The emotional weight is different now. In the beginning, this felt bold, calculated, strategic. Now it feels exposed, vulnerable, like standing in the middle of a field with no cover. Because now we've seen 2 full cycles. December, January, 2 months of data, 2 months of operating expenses, and nothing has broken upward. Nothing has changed trajectory. Cinema V2 improved, but only to $23. Dark Lore improved, but only to $36. Insider Military scaled attention, but only to $22. 26% more revenue. Those aren't anomalies, they're signals. Clear, consistent, undeniable signals. And when you add them together and get $134.30, when you look at the bank account and see what's left, it's hard not to feel the pressure. Because the burn rate doesn't care about optimism, it just deducts. Every month, automatically, relentlessly. You said you're more stressed now than when you started. Not because something dramatic happened, but because nothing dramatic happened. No breakout, no vindication, just continuation. Another month of effort for another month of minimal return. And continuation with a $2,000 monthly expense feels like standing on a treadmill that slowly increases speed. You're not falling yet, but you can't stand there forever. If I'm honest, there's one realization that's hard to say out loud. These channels are not broken, they're not failing, but they are not aligned with sustainability. They are not built to last. Each one has a strength, none of them have dominance. Insider Military has scale, Dark Lore has RPM, Cinema V2 has flexibility, but none of them have high RPM, plus high retention, plus strong monetization structure. None of them have the combination that creates compounding growth. And without that combination, you don't get leverage. You get effort-based revenue. You get paid for what you do, not for what you've built. So here's the question I've been avoiding, the one that keeps coming back. Should one of them be cut? If I were advising someone else, I would say, pause it immediately. Stop the bleeding. Redirect capital to something with a pulse. But when it's yours, it's harder. Cutting something feels like admitting you were wrong. And ego hates that. Ego wants to keep going. Ego wants to prove it can work. But ego is expensive. Ego burns cash while waiting for a turnaround that isn't coming. What if instead of 4 channels, there were 2 or 1? What if $2,000 monthly was concentrated into one flagship brand, one channel with everything? Better scripts, higher retention editing, premium thumbnails, clear niche positioning. What if instead of chasing volume, the goal became depth? What if instead of trying to make 4 things work, you made one thing undeniable? Because here's something January revealed clearly. Scale without monetization is empty. It's a hollow victory. But strong monetization with scale, that changes everything. That's the combination. Dark Lore has the best RPM. Insider Military has the best scale. What if one was engineered to combine both? That's a question worth answering. I thought the hardest part would be the numbers. I thought $134.30 would be the worst moment. It's not. It's responsibility. Because this doesn't exist in a vacuum. Your wife is stepping out of work for several months. That's real. The Shopify coffee brand is still bleeding, still consuming. And this portfolio was supposed to offset risk. It was supposed to be the thing that worked while other things figured themselves out. Instead, it added exposure. It became another problem. It multiplied the stress instead of dividing it. That's where the stress lives, not in $134.30, but in what $86 represents and what it means for everything else. If I stopped everything right now, what would I regret more? Stopping too early or continuing too long? That's the question that keeps circling. Because the channels are not dead. They are producing content and getting views. They are doing what channels do. But they are not compounding. They are not becoming more valuable over time. And compounding is the only thing that justifies the burn rate. Compounding is the only thing that turns exposure into leverage. This is where things shift. This is the turning point. The first part was documentation. Here's what happened. Here's where we start. This was diagnosis. Here's what's broken. Here's the structural problems. What comes next has to be decision, action, change. And I don't mean surface tweaks. I mean structural change. The kind of change that feels risky because it is risky. Here are the 3 possibilities I'm weighing. 1. Pause Insider Military immediately. Stop the bleeding. Reallocate the budget. Take the loss and move on. 2. Shift Cinema V2 away from shorts-heavy strategy. Force long form. Force real viewing behavior even if views drop initially. 3. Redesign Insider Military for higher advertiser appeal. Pivot the niche angle slightly. Make it more brand safe. Or accept that it will never monetize well and change the strategy entirely. Because if RPM doesn't increase, views don't matter. You can have all the traffic in the world and still go out of business. And if retention doesn't increase, RPM won't increase. You can't fix one without the other. Which means the next 30 days aren't about uploading more. They're about redesigning the machine. They're about changing the fundamentals. They're about making decisions that feel uncomfortable because comfortable isn't working. When I started this, I said this wouldn't be a success story. At least not yet. I said I would document the reality, not the highlight reel. This confirms that. This is the reality. This is the part they don't show in the courses. But here's what it also confirms. This isn't fantasy. This isn't passive income hype. This is real money, real risk, real exposure. January produced $134.30. The next month will either validate the model or force a hard cut. It will either show progress or prove that progress isn't coming. And I won't hide that decision. I won't edit around it. Right now, I'm not asking, will this work? I'm asking, is this structured to work? I'm asking, does the math eventually math? I'm asking, is there a version of this that makes sense? And if the answer is no, then the next move won't be emotional. It will be strategic. It will be the right decision, even if it's hard. That's what comes next. That's where we find out. No spin, no hype, no delay, just the next decision, whatever it is.